This is the property out in Des Moines, Iowa. And I'm going to go ahead and press play if you want to just sit back and relax and enjoy the brief video. And we'll go ahead and get started after that.
Be strong.
Well, that was just a quick video, drone video of the property itself, and I'll go ahead and start the presentation here. And thank you folks for that, those that have just joined us, and we're going to go ahead and kick this off right now. So with that said, can everybody see the executive summary that I have here on my screen?
Yeah, I can.
Okay,
yes.
Great. All right, well, good afternoon and good evening, everyone, and thank you for taking the time and the opportunity to join us here today. I know that it's a very busy time of year, so appreciate your time and consideration. So as most of you know, you probably saw the email that we sent out. This is going to be the Broadway Heights apartment project that we'd like to discuss with you today, based out of Des Moines, Iowa. Kind of gives you a glimpse of the demographics of where things are at. And so let's go ahead and get started. First and foremost, I just want to provide a quick disclaimer that you were invited to this presentation strictly as a confidential presentation format. So this is all individuals that we would know and that we have a relationship with. And so also wanted to indicate that the projections that we're going to be discussing with you is going to be in no way indicative of statements that are guaranteeing any types of returns. A lot of this is going to be due diligence on our part, from the team's part, in terms of their evaluation of the property itself and the general area. So with that said, the agenda that we're going to cover here is going to be about, I would say, 45 minutes or so, and then we're going to leave the last 15 minutes for any FAQs that you may have. And just for simplicity's sake, if you do have any questions, if you could just please add that into the chat, and we'll be able to answer that at the end of the presentation. So we're going to talk a little bit about, who we are, what basically is the process that in order to evaluate the property, give a brief overview of the market, as well as the business strategy of how this property and how it compares to the general area there in Des Moines, Iowa, and then also talk about the deal and the financials behind it as well. So basically, our main goal is to manage the whole end-to-end process in regards to investing in multifamily properties, and to provide you, basically our investors, the chance and the opportunity to reap those benefits to invest in private investment opportunities such as this. And it's actually uncorrelated to the Wall Street projections as well. So a little bit about FTW and the team. Real briefly, FTW is headquartered out of Kansas City, Missouri. And these are the co-founders that you see here. We have Logan Freeman, he's the Chief Development Officer. We've got Corey Tuck, who's the Chief Investment Officer, and Parker Webb, the Chief Executive Officer. And they actually own and operate over 1,200 units, which is primarily all true value add, Class B and Class C attainable housing multifamily properties. And real briefly here, this is the MVP Equity Group. Both Ted and I are based out of Seattle, Washington, and we have a combined experience of over 20 plus years in both residential and commercial real estate. And we're just very excited to be partners with Logan and the team on this project. And the way that we see it is that by partnering with FTW, it gives us an opportunity to actually expand our footprint and to allow our investors to invest in the Midwest's growing economy. And this slide here is a depiction of the rest of the back office team at FTW. Really nice and interesting is that the fact that they're continually growing, which is very exciting. And, there might be other individuals that aren't totally depicted here, but for the most part, I believe this is the majority of the back office team. So with that said, I'd like to go ahead and hand this off now to Logan, who will be able to walk us through the rest of the presentation.
Thanks, Ernest. All right, well, it's great to be with you guys tonight. Thank you for taking some time. And I do think that this is going to be a really informative presentation. And Ernest, are you planning on just capturing questions and waiting till the end, or are you wanting to go through those kind of as we go through? You just let me know and I'll stop wherever. If there's a point that somebody wants to talk through, I'd be happy to do that, or we can wait to the end. Up to you.
Yeah. How about we wait till the end? Folks, if you're okay with that, it'd probably be more efficient for us to capture that then at that time.
Okay, fantastic. All right. I'm just lagging behind just a little bit on going to the next slide. So I'm just waiting for it to come up. Okay. So this is a question that we get quite a bit is why invest in attainable housing? I think there's two main points to be made here. First, according to a recent study by the National Apartment Association and NMHC, which a lot of folks followed throughout the pandemic, 4.6 million new apartments need to be completed by 2030 to keep up with demand. I think that's a stat that a lot of people have maybe heard. And what that means basically is that there needs to be more than an average of 325,000 new apartment homes to be built. And that's each year, just for perspective, from 2012 to 2016, an average of 244,000 new apartment homes were built. And I just recently read in CBRE's latest study that they came out, their report. They talked through the deliveries for 2021 and what those deliveries are going to be concentrated in. You're going to see a lot of Class A new development being delivered over the next 12 to 24 months. It's really difficult in regards to building these, what I'll call attainable housing apartment communities, Class B and C multifamily properties, especially as everyone has seen the construction costs continue to rise to build these apartments. I'll touch on that here shortly, but I just kind of want to tease that idea out first. And then secondly, this is a newer trend, obviously, that we've been tracking for the last 12 to 15 months, but home ownership is downright impossible in many of the markets that we're focused on. Kansas City being one of the hottest markets, just landed on another list for 2022. And I just want to throw some stats out there and some data points to consider. 1/3 of the homes that sold in the past 6 weeks went under contract within 7 days of hitting the market. And that rate has been on the rise for the past 6 weeks. Obviously, during a time of year when the market typically slows down. And it's speeding up now because homebuyer demand is holding steady and strong. Home tours are up twice as much from January as they were in this time in 2019. Redfin's chief economist just recently said that homes continue to sell quicker and quicker. There's plenty of home buyers. A few more data points to consider. The median home sale price increased 13% year over year, all the way up to $358,000. And that's up 30% from the same period in 2019. 45% of homes sold above list price, and that's up 35% a year from and 22% in 2019. And those 2 points, among others, are why we feel what we're doing in the attainable housing investment space are going to continue to have a strong demand and deliver consistent returns. We'll talk a little more about that soon, but I just kind of wanted to tease out our investment thesis and the big idea behind that. And like Ernest mentioned, this is kind of what we've done and what we do here at FTW Investments. And it's our mission to continue to provide safe and affordable housing to meet this demand and to buy right, manage right, and sell right to provide our investors with exposure in their portfolios to this asset class. So we have over 900 investors in our group now. We've done over 25 multifamily properties. We're up to around 1,400 doors under management now, which is very exciting. We recently closed a project in Lincoln, Nebraska. Our goal is to do about 1,000 doors a year. This is a point I want to talk through, though, because this year, 2021, did not allow us to hit our goal in regards to the amount of doors that we added to the portfolio. We added about 600 units to the portfolio this year. Some of those carried over from pricing in regards to 2020, when obviously there was a lot less competition in this marketplace. And so there's a more uh, competitive environment for two reasons. One, there's been a new flight and entry of money into the capital markets in regards to commercial real estate in a big way, but also the fact that debt has continued to stay very lucrative for individuals to get these financing. And then there was a little bit of a scare in regards to the 1031 exchange. And I've worked on over 100 1031 exchanges in my career. And I can tell you, many folks were calling me figuring out if the 1031 was going to go away or what was going to happen with that. And that created a lot of competition in regards to multifamily properties. And then lastly, there's been quite a bit of entry into the Midwest markets as coastal markets have been continuing to have cap rate compression. Investors are searching for yield, and so they're moving into kind of secondary and third tier markets such as Kansas City, Des Moines, Nebraska, Oklahoma, and Arkansas. We're headquartered here in Kansas City, Missouri. That's our office building. We bought a 40,000 square foot office building this year. And if you're ever in Kansas City, please do let us know, and we'll take you out to some great barbecue. I think it's some of the best in the country. Okay, so now that we've talked a little bit about who we are, what we do, I want to talk about how we do it. And I think this is our secret sauce, and this is very important. I speak about this quite a bit, but this is how we manufacture opportunity out of thin air. And there are hundreds of steps and years of learning to distill this down into such a complex process into 8 steps, but I did my best. And so here that is. There's relationships, knowledge, experience, all wrapped up in this process as well. There's tangibles, intangibles, and everything in between. And refining this process is what I believe sets our group from the rest. And I think that it's important to understand the process that we go through, because we speak to a lot of investors all the time about the difference between being a real estate investor and being in the business of real estate investing. And if you're going to be in the business of real estate investing, meaning finding projects, managing them, taking them full cycle, leasing them up, working with the property management companies, you need a team. And I was glad to see that we had our team slide up there, and we've been growing rapidly and adding a few more folks to the team here in the next 2 to 3 weeks, which we're very excited about. So let's go to the next slide here. Okay, so we talked a little bit about the investment thesis, and when you're building that investment thesis, I think it's important to start with the markets and where you're trying to enter into, and those demand drivers that affect those decisions. Next we obviously get into the product type, which we're going to talk about soon, and the business plan, all backed with strong empirical evidence. And I think you're going to receive all of those things. But here are a couple of the highlights why we like attainable housing. There's a shrinking supply. Like I said, it's very difficult to continue to build this type of product and have the rents that are still what we call affordable or attainable. There's lower turnover rates. You have increasingly diverse renter base, which is very important as the United States continues to change in regards to diversity and things across the housing market as well. And I think the last thing I wanted to talk about with this is there's fragmentation, which is opportunity in my mind. Opportunity because these properties typically are not held by large, multifamily REITs or of that nature. They typically have not been in the attainable housing space, meaning I'm still able to contact direct to owners, and find properties that still have a margin of safety. I think that's so important. I'll just tell a quick story here, and then we'll move on to the next slide. But we purchased a 426 unit portfolio here in Kansas City last year, right around $46,000 a door. Now, this was 70s product, so the vintage was quite a bit older than this project. And it was in a time where not a lot of people were purchasing. But we just received a broker's opinion of value on our portfolio for over $90,000 a door. And, it just really goes to show when you understand the market, you find projects that other people are not bidding on, and you're able to win those projects, that you create this margin of safety that Buffett and Munger are always talking about. And that's what we're kind of looking for. We're value investors at heart. And I'm really keen on finding those deals that the replacement costs are much higher, and we have a big margin of safety going in. And I think we found that here on this project. So we briefly spoke about the supply and demand imbalance. And one of the things that I like to look at when I'm looking at new markets as well is the affordability metric. And it's widely accepted that spending 30% of your yearly income on rent is affordable. And so, for example, in a 1 mile radius of this property, the average household income is right around $77,000. So 30% of that figure would be right around 24 grand a year or $1,900 per month. And the current average rents on this project are right around $1,000. And the average pro forma rents that we'll see here shortly are $1,150. And so that's well below the acceptable affordable rate, actually 40% below the 30% affordable metric. So that's a really important metric for us to look at when we're looking at implementing the business plans on these projects. Because if the renter base and the resident base that you're looking to tap into has that disposable income and it's not even getting close to the 30% of their income, that really shows that you can start to actually push those rents to where you're looking to go. So, the last point I'll make on this is the cost of living in Des Moines. There's an indices that we follow. It's based off a U.S. average of 100. So an amount above 100 means that it's more expensive, and below then it's lower, and of the average. And the cost of living in Des Moines is 81.2 in the United States. So I just wanted to kind of make that point as well, because affordability is something that we're always making sure to take a close look at. So at a high level, here's the breakdown of the project. And what I'd like to point out here is that there are a few ways to participate in this project. We're going to get into that later in the webinar. But there is 2 classes of shares that you can invest through. The reason behind this is, there's investor alignment with their goals. We have a lot of different investors from that age ranges and their goals and what they're trying to do. And so we have the Class A1 shares, which is kind of a 10% preferred return, but there's no participation above that. So when we go to sell the property, you're not going to participate in the proceeds of that. You'll get your initial capital back, and we'll walk through that very shortly. And then there's a more traditional Class A2 shares with a 7% preferred return, and then a profit split above that at 70-30. And I'll walk you guys through that. So we have an average cash flow around 7%. Equity multiple for the A2 shares is 1.87. It's obviously 1.5 for the Class A1 shares. And I'll walk through that as well. Average investor return here is 17.3%. This is with a terminal cap rate that is on average 20 basis points, increasing 20 basis points per year. It's widely accepted that 15 basis points is kind of where you should be on your underwriting. We like to be a little bit more conservative on that, mostly because I backed into the sale comps of what the Des Moines market has recently traded at. And I felt really good about our exit, price per door. Again, I'm looking at price per door. And, we're projecting in 5 years a sale price of $145,000 per door. And there's multiple properties that have sold over $175,000 in the Des Moines market. So we could get more aggressive with that. I'm not comfortable doing that. And so we left it very conservative. And so there's a full basis or full percentage point higher on the terminal or exit cap rate than on our entry cap rate. Well, here's our investment strategy. So how are we going to push value in this project, and what's that process look like? So you have to acquire the asset. We're going to integrate the best-in-class property management systems and team. We're going to implement the light value add strategy as units turn, and I will talk you through that here very shortly. Utilizing a robust leasing strategy using digital marketing and social media. We're going to test additional income opportunities with fence yards. So the ground level units on these property have 2 entries to the units. So you have a back entry, and then you have your front entry that you have to go inside from. And, people in the Midwest love their pets. And so there is a dog park here at the property, but it would be a great, I think, amenity for people to be able to let their animals out the back and just be able to let them maybe use the restroom, get some fresh air, and then come back in and not have to go to that dog park. So we'll test that, and I'll talk through that as well. Pushing rents to market is obviously what we're going to do. In regards to this point, we're purchasing this property from a merchant developer. What that means is the developer has bought the land, they've developed the project, they stabilize the project, and then they look to sell after their hold period. And they don't typically work on pushing rents or pushing the value in the property because that's not their MO. And so there's a lot of builder grade materials in the units, and we'll show you those here very soon. Obviously, we want to leave some meat on the bone for the next buyer. And so what that means is, hey, we get done doing 85 or 90% of the units. Let's leave 5 to 10% for the next buyer to capture some of that value, and then we're going to exit the property. Okay, so Ernest, if the folks have not seen or looked at the deep dive that we did into the Des Moines market, I would highly recommend doing that so you can get a feel for the area and what continues to cause the corporate expansions, the job and population growth. But I do want to talk about the major kind of demographic trends that we've been tracking. And there's 4 key factors. It's worker, tech, venture, investor migration that continually drive consistent growth in the Midwest. And so I do want to speak about Des Moines just briefly, but again, we did a 20-minute presentation and a whole different slide deck just on Des Moines. And I would really recommend taking a look at that. But this is kind of a broader overview of what's happening in Kansas City, in Oklahoma City, in Des Moines, Lincoln, and Omaha. We've been seeing a lot of these type of migration patterns coming in. And one of the funnest, I think, metrics that I was tracking was kind of one-way tickets from U-Haul. It was a pretty cool graphic that I saw earlier this year. And, it's not the end all be all, but it was interesting to see the one-way tickets that increased into the Midwest, obviously, while people were working from home. So market perspective, I'll just walk you guys through this. These are some highlights of the Des Moines market. Some of the ones that I want to point out here are the metros areas. So Des Moines is obviously the capital of Iowa. And so there's a lot of government positions and jobs there. But in regards to other sectors, it's a national hub for insurance companies. So 81 insurance companies are headquartered in Des Moines. That's the highest concentration among United States metropolitan areas. And so that the area's finance and insurance sector has a $3 billion annual payroll, which is pretty impressive. Additionally, the crossroads of I-80 and I-35 make Des Moines a logistical sweet spot. 60 national and regional trucking companies are located in the metro. And then Des Moines is also home to 2 Fortune 500 companies. The first being Principal Financial Group, who recently completed $400 million renovation to its downtown campus, and then Casey's General Stores. So if you don't live in the Midwest, you probably have never been to a Casey's, but I definitely grew up going to Casey's General Stores, and they're all over here in Kansas City. They're headquartered 6 miles from the property here as well. A few other things: the cost of doing business in the greater Des Moines area is 13% lower than the national average, and the region has experienced a 1.7% growth rate since 2010. The average household income is right around that $77,000 mark. And a large part of this growth is due to the region's ability to attract and retain those young professionals that we've been talking about. So that's enough on Des Moines. I will direct you guys to our submarket analysis that we did in regards to Des Moines. I spent a lot more time kind of going through that. Here's the position of the property in regards to 2 major highways. 65 and Hubble Avenue is kind of a thoroughway fare here. Obviously, it's very close to good retail. So you've got your Walmart, your Aldi's and Lowe's and Targets and things like that, very close. And then you have Broadway Heights that kind of sits over here just below that. When we go to look at rent comparables, actually where Adventureland is and some of those other pieces and those other companies, it's a submarket called Altoona. And Altoona, Iowa is kind of just a suburb of Des Moines. And so if you see Altoona, just know that this property sits very close to Altoona. And that's why we pulled some of those rent comps from that. So, all right, we've talked about kind of FTW, investment strategy, Des Moines, and let's get into the business strategy a little bit. And so when I spoke about the value add strategy, so the picture on the left is kind of our current kitchen situation. So it doesn't look terrible, right? I mean, it looks good. We have nice appliances, good flooring, cabinets are in great shape, but you can just tell that there wasn't the level of detail that we would like to kind of see in our properties. And so, just for example, look at the cabinets. There's no poles on the cabinets, right? The lights are very common lights. And I think we can do some things in regards to that to really brighten this space up. Hard surface countertops are going to be a big focus for us, as well as backsplashes here in the kitchens. But again, when I walked every single unit of this property, every single unit is uniform, which is incredible when it comes to building budgets and being able to actually implement these strategies, because we're not dealing with different subsets of different strategy or different finishes in each unit, which I think is really important to know. So we're going to be able to dial our budgets in for each unit very closely to being very uniform, which is exciting. There's a big island here in the middle of the kitchen, which a lot of residents love. And you see our budget. I'll show you guys here in a little bit our budget, but our budget is highly focused on getting some hard surface countertops in there and really elevating the feel of the kitchens. Same thing here with the bathrooms. Okay, so value add strategy on the bathrooms. Again, take a look at what we've got here at Broadway Heights, builder grade. Like, for example, look at the mirror. I mean, that looks sort of like the mirror that I have plastered on my home gym, but not a mirror that I want to see every time I'm using the restroom, right? And so the vanity, the mirrors in the bathrooms, a lot of the bathroom floors actually have 12 by 12 tile. Tile is great. It's durable. It lasts a long time, but it doesn't necessarily stay clean, especially the grout in bathrooms, and it doesn't have a good feel, and it's cold. Believe it or not, with our residents, we get a lot of feedback in regards to that. And so just brightening the space up, creating some more kind of what I'll say comfortable and modern color palettes and modernizing the bathrooms is kind of the next piece of the value add strategy here. Okay, so I want to talk really quickly about the different floor plans that we have in Broadway Heights. And so but before I do that, one thing I didn't talk about was that Broadway Heights provides residents with an apartment playground. They have a big dog park. They have a community room. We've got a kitchen and clubhouse, 24-hour fitness center, a business center, a theater room, and garages for the residents. And then additionally, washers and dryers in each unit. And so that's one thing that's not really shown here, but one thing I do need to kind of let you guys know about, that it is highly amenitized in regards to that, not to the Class A standard with the dog washing stations and things like that, but it sits in a very nice location, and it also has a lot of amenities for our residents. So this is one of the 4 one-bedroom floor plans that the property has. Broadway Heights has 24 one bedrooms, 75 two bedrooms, and 21 three beds. And the data points here are important to understand. So we've got the current rents, the pro forma rents, and the market rents. And I think this does a good job comparing them in real time. And one thing I would like to point out as well is the last point on each slide and the next 2 slides in this one are going to be the same. So remember that 30% attainable metric of 1941. And so our pro forma rents are about $1.60. And I'm going to show you a rent comp that's already achieving that right now. And our current rents are right around $1.31 to $1.45 per square foot on the one bedrooms. In regards to the 2 bedrooms, our current rents are somewhere between $8.35 and $10.52, or about $1 to $1.16 per square foot. Our pro forma rents are right around $1.40, and the market rents are currently supporting $1.42 with the same finishes. And then our 3 bedrooms, which, believe it or not, in speaking with the property management company and looking at the supply and demand, 3 bedrooms are in high demand. Look at this. They're almost 1,200 square feet. And that's larger than some houses here in the Midwest. So we have a lot of room, a lot of demand from families in regards to these 3 bedrooms. And so there's a waiting list on these 3 bedrooms, which is very exciting for us. And so our current rent's around $1,068 to $1,220. And so that's $1.22 per square foot. And I'll show you in that kind of goes to right around $1,345 per month. And there's already rents supporting $1,500 a month in regards to these 3 beds. So I think there's a lot of opportunity here on this rent analysis in regards to the 3 bedrooms, which gets us very excited. So here's some comparable properties in the area. So one thing we're always looking at is vintage. So you'll see Prairie Woods, 1972. That's typically what we have done in Kansas City, more of the Class C or B- type of product. Altoona Towers is definitely our main comp that I'm going to be walking you guys through. And I think it's really important to look at the finish levels of Altoona towers. And let's do that right now. So here's our comparable highlights. So a couple highlights here. The studio apartments are demanding $960, which are 200 square foot lower and less than our one bedrooms. And it's very close to our projected rents for our one beds. And secondly, I'd like for you to evaluate the finish level of these apartments compared to Broadway Heights right now and where we're going to be taking them. So if you look at the last two pictures here on the slide, they don't have cabinet pulls. They don't have stainless or black appliances. They have white appliances. Some of them do have backsplashes. They do have hard surface countertops, and they have some upgraded lighting packages. But in regards to where they're at currently and where Broadway Heights is very close in regards to that finish level, other than the hard surface countertops. And these guys are already pulling some really impressive rents when it comes to what we're trying to get to in our property. And I think that that's really important to compare. Again, this is in Altoona, which is very close to our property. And so I think that looking at this is really important because it shows the organic rent growth, and organic rent growth meaning when we do purchase the property and we're going to push rents, we will test different finish levels to make sure that we're not overpaying for the organic rent growth to meet our model. In Kansas City, on that 426 unit project that I mentioned, I had budgeted about $7,500 per unit because we're definitely not spending, trying to move the class level up of our property. But we spent $1,500 on over 50 units in that portfolio already. I was modeling $70 rent increases by year 3. We're on year 1.5, and we've already been able to increase the rents $150 on that property. And so I do think there's organic rent growth here on this project, and something that I want to make sure that we test out very closely so we don't go overspend on the property, and we might be able to push these rents without having to do all of the work that we're setting out to do. And so I just want to make that point here. Cost segregation, obviously a very big benefit in regards to investing in commercial real estate, and bonus and accelerated depreciation is a major driver for many people in regards to investing in real estate. So this is kind of an estimated, what I'll say, year 1 paper loss. Again, this is a preliminary estimate, and this is subject to change. I am also not a tax accountant, or this is not tax advice or legal advice. I am just speaking from the previous 25 plus projects that we have done and what we have seen on our projects. So meaning, if you invest $100,000 in this project on your K1 and your year 1, you're going to have a tax write-off or a paper loss somewhere between $50,000 and $75,000, even though the property was cash flowing. And that's pretty powerful when you're thinking about your tax strategy and keeping more of the income that you're making. Okay, we've talked a lot about the project. Just want to dive into some of the investment overview. So what type of debt are we getting on this project? This is a really important slide. I'm sure many folks have been watching the economy, capital markets. I am an avid reader in regards to Howard Marks, Ray Dalio, Richard Duncan, and keeping in tune with what's going on. My favorite quote from Howard Marks is, he never answers a question that begins with the word when, but you better know where you are in the cycles. And so that's very important to our investment strategy. And so on this property, we have a 10-year fixed loan. The reason being, if for some reason in year 5, when we're looking to exit the property, interest rates have jumped, which will obviously limit the buyer pool and the price that they can pay. We have an extra 5 years, if needed, to be able to actually hold on to the property. And so having the flexibility on exit strategies, by the way, I also think that this property has a really strong opportunity to sell before year 5, but we're always modeling a 5-year exit. I know a lot of folks that have shorter hold periods. The IRRs and things look better, obviously time value of money. But we're long-term holders, and we want to make sure that we're mitigating the downside in regards to the risk. So this is a Freddie Mac loan. It's going to be right around $9.9 million, 75% loan to value, interest rates at 3.5. And again, we have our kind of our 10-year fixed interest rate on that project here. So funding structure, this is important to understand in regards to the waterfall, which we can spend some time with. I know there will be questions around, but just kind of wanted to walk through the cap stack. So obviously the senior debt gets paid first. Class A1 shares get paid second. Class A2 shares are paid after the A1 shares, and then the general partners are paid their profit, split above that. Minimum investments, $50,000. Preferred return, obviously 7% for A2, 10% for the A1s. Just kind of wanted to put a visual there for you guys so you could take a look at that. 5-year cash flow projections. Okay, so what's important to look at with all of these numbers? I think it's the effective gross income. And when you look at a pro forma or the cash flow projections, it's really important to understand when you're getting to that stabilized kind of effective gross income or NOI, whichever metric you would like to look at. And by year 3, you'll start to see the NOI and the effective gross income really start to stabilize right around 1.8. That's because it's going to take some time to renovate these units and push the value in the property. That's why I think that the year 3 to 4 might be a really good opportunity to kind of see where the market's at after we have pushed a substantial amount of value in this property. The debt service is obviously going to go up after year 3 because we have 3 years of interest only. So if you're wondering on year 4 why debt service goes from 347 to 534, because our interest only period does burn off at that time. Always like to try to visualize this for folks that are looking to invest in a project, because everybody's favorite radio station is WIIFM. What's in it for me? And I agree. So let's walk through that. And so for a Class A1 investment, this shows kind of where your projected returns would be on that. And so it's going to stay pretty simple with this one, since it's a 10% preferred return, and there's no participation on the upside whenever we are going to sell. So you're going to get your $10,000 for the 5 years. You can get your capital back. Equity multiple is going to be 1.5. So pretty simple on the Class A1 shares. Where it gets a little bit different is the Class A2 shares, because you're going to be participating in that, the capital gains and the proceeds. And so on $100,000, you'll see here in year 5, the distribution from the capital event is actually $151,000. And so your equity multiple, which includes your cash flow for the first 5 years, is also going to be higher on the Class A2 shares. It's going to be right around 1.87, which is fantastic in my opinion on a project like this. You do have the opportunity to kind of blend those approaches. And so let's say that you may want to get some of that 10% preferred return and get some of the upside. Well, this is what that's showing here. And so your equity multiple here is going to be about 1.74. Cash on cash is going to be above 8%. And you're going to have your 10% kind of preferred return on the A1 investment shares. And you can blend this however you feel that would be aligned to your strategy. And so we have some investors that are doing this, and I'm really happy to see that, and being able to find a project that allows folks to get both kind of allocations in one project is really exciting for us as sponsors. So that shows this here. Hold period and waterfall. One thing to note here is very simple. So when you think about kind of the waterfall structure, I think that think of this literally as water flowing down from a mountainside and dropping into those different buckets. And depending on the class of shares that you have, what we just detailed, your bucket's going to be filled up in order to, in proportion to the size of your investment. And so this shows all of those details and flows right back to the $100,000 breakdown that we just shared. There's a lot of numbers here. I know these numbers front and back, so I can walk anybody through questions that we have about the waterfall, how that's impacted when we get finished, because I don't think there's that much value showing a bunch of numbers that you probably have a hard time reading. This is important to understand. So sources and uses in regards to the project. So this is obviously going to talk about the debt that we've got that we mentioned earlier. There is a limited amount of the A1 shares that we're raising for this project. It's right around 1.5 million, and the rest is going to be raised in common equity or A2 shares. We have our renovation capital improvement budgets here as well. and all of the financing and acquisition fees and things like that are contemplated here as well. This is going to show what we're spending the money on. And this is really important to understand where the renovation budget is going. And like I mentioned earlier, it's really heavily focused on the flooring, on the countertops, and on the backsplashes here in the kitchens and the baths. Thankfully, this is new product, 2014, 2015 built, which is very exciting. So not a lot of CapEx in regards to mechanical, electrical, and plumbing, or MAPs, like we like to say. We've got an acronym for everything. So this is just an overview. We've talked about most of these points. One thing I will mention here is the distribution and reporting timing. That's on a quarterly basis. We've got our projected annualized cash flow distributions, hold periods, how much equity we're raising, and then obviously the asset class. One thing too to note is the property management company. Very excited for the property management company, which is Alexander Forrest, AFI. AFI has a very unique way of managing properties in regards to how they train their property managers at. They actually are based out of Columbia, Missouri. They have over 10,000 units that they manage across the country and in Des Moines, which is great. But they actually have a training program that their property managers have to go through in Columbia. Then they have to go live on a property for 6 months, and then they get acclimated to their next assignment. So I'm not going to say it's a cult, but after meeting with them and meeting with their property managers, the way that they talked about and the pride that they took in their job was second to none, which we're very excited about to have Alexander Forrest here on this project. The second backup option in regards to the property management company is we put a formal RFP process out to 4 or 5 different property management companies. We think they're all capable. AFI came in first. Indigo Living or Hubble, who we're buying the property from, is in second place, and that's really dictated from Freddie Mac, our loan, our financing partner, because they really like to see folks that have 3,000-4,000 units in a market this size. And so we do have, and we are set up if Freddie Mac has any questions around AFI, which they have not voiced yet. We're set up and ready to go with Indigo Living or Hubble. Third is Lloyd Management out of Des Moines, Iowa. They have a great presence there. And then actually our property managers in Kansas City have over 700 units in Des Moines that they manage as well. So we have even a third or fourth runner up here as well. So I feel very comfortable with the property management teams that we have laid out for this project, which is exciting. In regards to this investment, I think there's downside protection, upside potential, and unseen benefits. We've talked a lot about those, throughout this presentation. I'm happy to chat through some more of those here at the end here, but I do want to get to some questions here very soon. So let me keep motoring through this, guys. Okay, so the investor experience is important. So we're obviously doing the webinar right now. The second step is obviously asking questions, reviewing this offering memorandum, the pro forma, the PPM, which is the private placement memorandum in regards to actually subscribing to the project. I'm sure Ernest has already got everybody set up, or at least access to the portal, which is very exciting. For the first couple months, at least 3, we're going to have monthly updates. Our team will be on site working with the property management company. We have weekly calls with the property management company, and then we move that to monthly after we feel like the transition has gone through the right process. And then you'll receive your quarterly distributions. And then obviously we have all kinds of, and I'm sure Ernest and Ted have these as well, free training resources, things that we're putting out on a regular basis to try to continue to educate our investors on new markets, new asset classes, and new investment opportunities. So without further ado, Ernest, I will let you ask any questions that have maybe popped up throughout the process. And happy to dive into any more of what we covered in detail here.
Okay, great. Thank you. Let me go ahead and look at the chat here real quickly. All right. So I don't see any comments in the chat, but I guess I can open it up now to everyone else. If you have any questions, please feel free to ask them. All right.
So I can go through some frequently asked questions that I get on a regular basis, Ernest, if that would be helpful. Maybe that will spur some discussion. And one question we always get is as general partners, how much money are you guys putting into the project? And typically, on any given deal, we have 5 to 10% of the invested equity needed to put into a project. On this project, it's going to be a little bit over $300,000, and obviously, we're signing on the loan. So that's a good question that I typically get in regards to making sure the investors' alignment with the general partners are very important.
Hey, this is Raghu. I have a question. So on that blended investment, that's a mix of A1 and A2. Is that 100K blended, or is it 100 plus 100? What is the investment minimum there?
Yeah, so our minimum is $50,000 on this. That was showing. I don't have the slide in front of me right now, but that was showing a blended approach of $100,000. I believe it was 35% of that was allocated to A1, and 65% of that was allocated to A2 shares. So 35,000 and 65,000 respectively.
Understood. Okay, thanks. And what do new investors who are new to this kind of an investment, right, who haven't done before, what do they typically choose? Is that the A1 or A2 or blended? What do you recommend for a new investor?
Yeah, that's a great question. So I'll first off and say our company has raised right around $30 million of equity now. And our average investment for our projects is a little over $85,000. And that's a lot of investors. That's a lot of checks. And so there's, ranges from 7 figures down to the minimum of 50,000. When we talk about the different types of classes of shares, I think it goes back to what the investors' goals are and where they're at in their investing career. Meaning, we have a lot of folks. I'll just tell a little story. We have a lot of folks who are looking to potentially exit their W-2 job in the next 5 to 10 years. So they're really focused on trying to replace income. And so they're looking for high cash flow projects and things that they can rely on to kind of, produce a decent amount of cash flow. On the flip side, we have maybe some younger investors, 30s, 40s, 50s that, they're fine working their job as a W-2 employee. And they're looking to really recycle capital and trying to make their $100,000 as much as possible and continue to roll that into kind of the next projects. And I saw this illustrated on LinkedIn the other day very well. And it mentioned trying to reach your financial freedom in regards to investing through syndications. And they had kind of a graph that showed what it would look like to invest $50,000 every single year, reinvest the cash flows, and then on the 5-year period, actually take your exit and then reinvest that. And by year 10, they had replaced an income of $100,000 through an 8% return on investment and investing all of those cash flows into the project. And so I thought that was a pretty powerful way to illustrate what you can achieve here. But I think it really comes down to, am I looking to take $100,000 and make it $187,000 like you could in this investment opportunity over the 5-year period, or am I looking to replace that income? And if it's both, great, you can do the blended strategy. But I think it really comes down to kind of what the investors' goals are. We have folks all across the board. I've got investors that are 80 years old, and I have 24-year-old investors, and they obviously have a lot different goals when it comes to what they're trying to do with their investment. The Class A1 shares can be looked at as less risky. And so just because of the preferential treatment in regards to the placement in the capital stack. And so they are paid before the A2 investors, but they don't have any participation when you go to sell. So if you're looking for a less risky, and I did my air quotes, not that you guys can see me, but that would be the kind of indicator in regards to that would be Class A1. But if you're looking to recycle and make that sum of money larger, the A2 shares are kind of your best bet.
Thank you.
Yeah, I've got a question. So on the 5-year term, if that gets extended to the 10 years, is there an exit strategy for people that want out at the 5-year?
There is. Yeah. So what you can do in a project like this is Freddie Mac allows for supplemental loans. It would be somewhat like think about it as kind of a cash out refinance. But it's more or less just adding more debt because of your net operating income being at a higher level. So your debt service coverage ratio can increase based on the NOI that you have on the project. That would be something that we could evaluate at that time. I don't foresee this being longer than 5 years, simply trying to make the fact that, we get a lot of questions in regards to mitigating risk with interest rate and things like that. And, I'm not a forecaster. I don't forecast. I look at where we're at, not when we're going to change. But with that being said, do want to have kind of opportunities to ride out the storm, so to speak, if needed. But if there was a way that we needed to add additional debt to the project, that is an option with this capital stack if we were to hold it longer. And that is something we could evaluate at that time.
Cool. Thank you.
All right. Any other questions? I think
Ernest, one of the questions that I get quite a bit too is, obviously we're stabilizing in year 3. The cash flows really start to peak when you look at the cash flows between years 2 and 3. And if the preferred return is not met, what happens is kind of a question that I get. And so back on the waterfall slide, there is a couple of lines on the pro forma and that financial model that shows 2 lines. One is preferred return beginning of period, or BOP, and then end of period, EOP. The preferred return accrues to the next period if it is not met. And that is dictated and shown in the waterfall as well. So just wanted to kind of talk through that, because a lot of investors do ask us about that question as well.
Yeah, that's good. Thank you. Logan, I do have one. I think this was a question that come up, numerous times too, as well, is have you had any capital calls in any of other cycles that you've done in the past?
We have not, and we have not had any capital calls. And up until about last month, I was able to say that we had made every scheduled distribution that we have ever had on our project, even through COVID. Believe it or not, the reason because of a distribution being paused had nothing to do with COVID. Unfortunately, it had everything to do on a high-rise apartment complex that we own. We leased space to a cell tower, and the cell tower had some repairs that needed to be done. When they did the repairs, they redirected the water lines or the drainage system into our HVAC system, which then flooded our 10th floor. And we had to move all of those residents out of their units, put them into other units, and do a whole shuffle. And that took a couple months and to remedy that issue. So I'm always very transparent about, any issues that we have on a project. I don't foresee anything like that happening on such a new project here. But up until, November of this year, we had made every single distribution across about 1,300 units that we set out to do, which, I'm very proud of. And obviously there's unforeseen events that happen in real estate, and you have to deal with them. And we were very transparent and open with our investors about that. And we're going to get that rescheduled for this quarter, which is good.
All right. That's great. Thank you, Logan.
So to follow on that question, I am interested in sort of total and partial loss of the project, fire, winter storms, things of that nature. How would you handle that from
Sure.
distribution standpoint?
Yeah. So in regards to any type of claim that is made on the properties, we have a 162 unit apartment complex here in Kansas City. There was a fire in that project. It took down 8 units, which was unfortunate. We had to manage through that whole process. And we since it was only 8 units out of the property, we didn't have to miss any distributions. But if we would have, and that would have impacted the cash flows to an extent that we could not, we would likely pause distributions until that claim was paid out. If we felt like our cash reserves were not at a substantial amount that we had, our operating reserves that we needed to operate the property. So it's a very specific use case on that. In regards to, risks that I see on this property, I would say definitely hail damage, but that's not typically going to put units down. But tornadoes will. I say that lightly, but obviously we've gone through some tornadoes here recently, and tornado ripped through my hometown 2 years ago and devastated it as well. So it does happen. And in that scenario, we'll have to manage that with the insurance company, kind of do an estimation on how much time that would take for us to get our claim kind of put back together. If it was a total loss, which, you know, is rare, but is an option, then absolutely distributions would be paused for that time. Everything would still continue to accrue in regards to the cash flow, and we would have to reevaluate if we needed to rebuild or what we were going to do, if we were just going to take our claim and disperse to investors, or what we needed to do at that time. I hope to never be in that position, but I do know that each one is pretty specific and unique to that. But it would just come down to the impact that it has on the cash flows, our cash reserves at that time, and what we felt like was a good operating account for us and the property, not to have to make obviously any capital calls, and us to make our debt service coverage ratios.
Thank you for that.
Yeah, Ralph, I hope I don't have to be in that position, but as a real estate operator, you know, I've been in some really interesting situations over the last 5 years. So anything can happen. That is for sure.
It can. I've seen apartment fires, hail damage, floods, all kinds of things. So as well as tenant related property damage.
Absolutely.
All right. So if there are no other questions, just being cognizant of time, Logan, if you wanted to kind of step us through here with the timeline and next steps, and I think that should be the end of it.
Okay, sure. Absolutely. So, you know, what's the timeline on the project? Well, right now we're targeting a closing date of January 21st. We have a little bit of leeway in that timeline, but I do believe we're going to be able to hit that 21st date. But if it needs to be pushed to the 28th, we have that kind of that leeway or flexibility. So we're looking to fund the investments. The second, we're funding currently right now, but by the second week in January, obviously we can fund up until closing, but having that done before closing is those closing weeks and days are quite the process on a project like this. It takes a whole team to get that done. So we have our funding deadline of January 14th. Just know that there's a little bit of flexibility in there. The legal documents are available in the portal. And so, Ernest, I'm sure you have communicated how to get to that portal. The portal is hopefully you guys are familiar with the portal. It tries to really simplify the process. So we've also put together some documents in regards to how to utilize the portal, a few videos about that as well, and then some FAQs around the subscription process as well, how to fill those out correctly. Because you can invest as an individual, as a LLC, you can invest through retirement accounts. There's many ways that you can fund the projects here. And so each one has to be dictated in the portal, and there's documents for each entity that is investing in the project. If you have questions around that, please direct those to Ernest. Ernest will reach out to me, and then our investor relations team, Crystal, Lee, myself, and Jill will be here to help through that process and any questions that they have. So the process really goes through, you go to sign up for the portal, you evaluate the legal documents. Once they're signed by you, we will be then notified. And then our director of finance, who has over 30 years of private equity experience, we reviews all of those documents. Sometimes there's things that need to be changed or corrected. And so we want to have that correct before we fund. Once they are correct, then we will go ahead and send wire instructions to the investors to actually fund the project. And so I think I got through all the steps there, Ernest.
Yes, you did. Thank you so much, Logan. And real quickly, just for the folks here still online, that the investor portal, we're going to be sending that out here shortly this evening for you guys to get access to that. So again, if you have any questions, I know we went through a lot of information here at one time, so please don't hesitate to reach out to myself, to Ted, or to Logan directly as well.
Thank you, Ernest.
Great, thanks. Will you send us the recording?
Yes, the recording will also be sent out right after this meeting as well.
Excellent, thank you.
Thank you. All right. I think that about wraps it up. Thank you guys so much for your time and being able to attend today's meeting. Again, thank you for attending and good night. Thank you. Thanks,
Thank you,
everyone.
guys.
All right, good night.
Take care.